At this time, I want to welcome you to Focus on Liberia. Again, folks, I want to welcome you to Focus on Liberia. Today is Saturday. It's 3 o'clock, 3:14 Eastern Time, and I want to welcome you to FOL Marketplace. FOL Marketplace is a business and economic forum where we come and talk issue about business and economics. And today we are here. I am Ansony Sieh hosting, along with my partner, William Bernard King. He is a real estate guy, and guess what? We are talking about real estate. We're talking about mortgages. You want that house, you got that house, how it all happened. He knows all the things that happen in the back end. And also, when you have that home now, what all do you need to know? So, we are talking mortgages today uh, in this business and economic forum called FOL Marketplace. We will be talking mortgages in America, the pros and cons of mortgages in America. I am happy to be here with you, our audience. As we always ask, please hit that share button for us. If you have a home, you must be here. If you are planning to get a house, this is your platform. We are here to talk about that house that you want, the pros and cons that you need to know so that you are able to navigate your way around the terrain and get that house on a very good deal and not emptying your entire bank account. Sometimes that becomes the case, but you need to know the pros and cons. No one other than William Bernard King, well positioned to talk about this at Focus on Liberia. Mr. King, welcome.
Yes. Anthony, how are you doing today?
I'm doing well. I'm doing well. I know I'm happy to be sharing this great platform with you today.
Oh, yeah, this is an exciting topic. I always get excited about this because I think I'm someone that I appreciate and I admire. And anytime I can contribute to somebody gaining wealth is just a very good thing. And so that's what we're going to talk about today. Is just one of the many, many tools that's available. Before we get into this good thing, let me know when I can do my disclaimer so that we can move forward, jump in the show.
Yes, very quickly, go into your disclaimer and then we will get started.
Thank you. The content is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice. Nothing contained on our media or written documents constitute a solicitation, recommendation, endorsement, or offer by FOL or any third party service provider to buy or sell any securities or other financial instruments in this or in any other jurisdiction in which such media material may be shared. All content on this site is for information of a general nature and does not address the circumstances of any particular individual entity. Nothing in the media constitutes professional or financial advice, nor does any information on the platform constitute a comprehensive or complete statement of the matters discussed or the law relating thereto. Thank you, Anthony, very much.
William Bernard King there, reading our disclaimer. Basically, what we try to say is that whatever information we share here, you cannot base your business decision on that. If you are trying to get that house, you have to talk to somebody at the bank who should further advise you before you make that decision. Because our fear is that you acting on the information we provide here, you make a decision, you say, oh, the guys are focused on Liberia, got me into this trouble. We are sharing this basic information with you. We know it is authentic, but we are also cautioning if you are making a decision based on the information we're giving, you're doing it at your own risk and you can't hold or liable or responsible. On that note, folks, we are here and we want to go into a bit. William, let's start with the basics, right? You know, mortgage, mortgage,
Yeah.
mortgage, mortgage, money, money, money. So tell me, what is a mortgage?
Yeah, thank you very much. I mean, in a very simplistic way, a
Right.
mortgage is pretty much a loan that a bank or a financial institution
Mm-hmm.
or anyone out there who have money will lend you, uh, and they will use your home
Mm-hmm.
as the security, or
Right.
they will say, "My man, if you don't pay me, I get to come and I get to take your house." So it is a loan that your home or the home that you will be buying, that is the collateral, that is the security that you use to acquire that mortgage. It's an instrument, an IOU instrument that a lender likes to hold in his possession to show that you owe him some money.
So, I'm a guy who rented for quite a long time before making that
Yeah.
decision to get that mortgage. And
Mhm.
there are some people who are still in that situation today, many also thinking to get that mortgage. What will be the difference? How can you explain it looking at a rent payment and mortgage payment? What are the differences and are there disadvantages and advantages that you want to share with us?
Yeah, definitely. There are definitely advantages to both. I
Hmm.
mean, those are just options depending on where you are in your life. So let's look at what rent is, right?
Hmm.
So rent is basically your commitment to someone who owns the property
Hmm.
that says that I will let you live in this property, and every month we agree that you're going to pay me X amount of dollars,
Hmm.
and you're going to pay that amount. Let's do a 1 year contract, which is what normal rents are,
Hmm.
or 6 months contract or month to month contract. So let's do that, and you pay me. Now, your rent is just one item, it's a rent expense.
Hmm.
And depending where you are in life, you cannot look at that as you're going to be buying that property. That's just rent. So you give the money to the guy for living there. A mortgage, when you own a mortgage, is a difference, meaning that now you're saying, I want to own this property that I live in. So I want to buy it and I want to make payments on this property, what is 15 years, 5 years, 20 years, so that eventually I will get to own this property. Now, with the rent, if you can't pay the rent no more, obviously the landlord comes and say, my man, you got to move out.
Yeah.
I give you 30 days to pack your things and go. Now, with the mortgage, if you can't pay the mortgage or you fall behind, the financial institutions or the lenders, they try to work out so many different ways or different plans
Hmm.
so that you can save your home.
Hmm.
And normally those things will take between 90 to 120 days. So you will be staying there, rent free while they working it out and you working it out with them until you figure out your next move.
So, William, let's take an example. A family of two or maybe three. They're like, oh, we
Mhm.
wanted to, so the apartment works out for us in terms of saving in the long run. Based on your experience as a real estate guy,
Yeah.
if this family is saying, hey, though the renting is working for me, but my goal is to be able to save money in the long run,
Mhm.
what would be your advice to that person despite their family size being minimum of two or three?
Right. So, well, the one of the main thing is that understand that when you are renting,
Mhm.
every year, no matter where you are in the U.S., the landlord has the right to increase the rent
Mhm.
at a minimum level
Mhm.
set by the city or set by the state or set by the market.
Mhm.
So in Los Angeles, where there's a popular demand for homes, you have rent control. So that means you can only increase the rent by 2 to 4% a year.
Mhm.
In other cities where there are no where there are no rental limits, you
Mhm.
can increase the rent by anything you want at the end of the 12 months contract. So if you're in a situation where you're living and it's good and you're able to save money when you're renting because your rent is cheap, so you're saying I'm saving money, yes, but remember that if you're in a place there's no rent control, the landlord after 12 months can jack the rent up. Or if it is, every year the rent goes up by 3%, 4%. Now, the good thing about mortgages, depending on what kind of mortgage product you get,
Right.
you make a fixed payment.
Mhm.
That payment will not change for 30 years. So while your income could go up every year, or people could become earners, your mortgage stays the same. And every month you are paying a little bit on the balance. So every month you get to own more of the house.
So
So that's something there.
okay, so William, I hear about refinance. I heard some. I had a friend who was telling me, "Hey, Anthony, this is a good time to refinance. You might see a reduction in your mortgage payment by $100. Man, I mean, $100 in 30 years, 25 years. That's a lot of money you will be saving there. So my question is, with mortgage, does it mean that if you refinance, chances are that you can reduce your payment and it will stay like that, unlike rent that will keep going up?
Well, yeah, I mean, you look, you know, you're going to look at the refinance market. People refinance for different reasons.
Okay.
So let's say when you bought that property, you bought it at 4% or 4.5% interest rate,
Right.
because that's what the interest rates were.
Mhm.
Then all of a sudden, the federal government decides that, you know what, we're going to lower the cost to borrow money.
Right.
So what that happens is that that cost savings in the mortgage world, lenders try to pass on some of that cost savings towards you. So they do that by also lowering their interest rate. So yes, you can go in there and you can refinance. And when you refinance on a lower rate, that means that your payments will go down,
Right.
definitely, and you're going to reap some more savings on that one. Now, one of the things you have to understand is that it depends how many years that you want for your mortgage. So if you've been paying for 10 years and a guy comes to say, let's refinance, well, if you want to refinance in 20, you are in the 30 years, you're spreading a lower amount of principal balance over a longer period. So yes, you're gonna incur some huge savings, which is gonna be great for you.
All right. So let's come to you being able to make profit. Is it
Yes.
possible that the person who owns a mortgage can make
Mhm.
profit on top of the mortgage, even though they intend to own the property? They can make money on top of it, right? Compared to somebody who is renting in the long run.
Oh yes, definitely. So, well, in the United States,
Mhm.
um, they make it they make it easy for you to own a property. They give you incentives.
Mhm.
One of the incentive is the interest rate.
Mhm.
So when you're making that monthly payment or mortgage, let me take a step back and tell you what a mortgage is.
Okay.
In a mortgage, there are really four payments, 4 to 3 payments. One of them is the principal,
Mhm.
the other one is the interest, the other one is the tax, and the other is the insurance. So when we say what's your mortgage payment, it consists of those 4 pieces. So what happens is you get a chance when you do your taxes,
Mhm.
depending on your state and depending on the advice of your tax guy.
Right.
But generally, there's you can get some deductions from the taxes and from the interest. So your tax return, if the government was going to charge you on a bigger income on your tax return,
Right.
now you're going to get charged less. So there's some huge savings there, and there's the encouragement.
Okay.
Now the other place where you can make some money on your mortgage per se
Mhm.
is when now you become the landlord.
Okay.
So you are a landlord, you've been staying somewhere for 10, 15 years, you refinance into a very low interest rate, and you say, you know what, my family has grown. I want to move to that bigger house.
Right.
And you look around in your area and you say, oh, wow, my mortgage is $600, but the rent over here in this area is $1,000
Mhm.
for a house like mine. And so what you end up doing is you purchase a new home, you put your home on the market for rent. After 3 months, 4 months, you get a good tenant in there,
Right.
and every month they pay you 1,000. So the renter is paying your mortgage. You take the 600, you
Yeah.
pay your
The mortgage.
PI,
Uh-huh.
yeah, you pay your mortgage,
Mhm.
and now out of $400, you can
Use it
send it
for
back home
utility
to
bills,
Liberia.
maybe.
No, you can send it back home to Liberia to build your school, because that's what we normally do, right?
Right. Great
You send
conversation
it to
there.
some other school fees,
Mm-hmm.
but you can do many things. You can then take some of that, get some life insurance if you want,
Right.
or pay some bills, or maybe continue to contribute to your kid school fees and so forth.
Right.
Yeah. So go ahead.
All right, folks in cyberspace, you are watching FOL Marketplace. FOL Marketplace is a business and economic forum where we talk issue of economics and business, and sometimes about economic decisions that you can make in your life or in the life of your family that may end up benefiting you tremendously in the long run. Uh,
Yes.
let's talk about the different kinds of mortgages. I'm talking about,
Yes.
the one from the government. There's that another one, and then the one from the financial institution, or Wells Fargo and another
Correct.
bank. So tell me about those.
Well, thank you very much.
Mm-hmm.
So there's the FHA, which is the Federal Housing Authority mortgage
Mm-hmm.
product
Right.
that is available. It's called the FHA. For short, we call it FHA.
Mm-hmm.
And then there's the conventional mortgage. The conventional mortgage is the private market where banks, like you mentioned, Wells Fargo, BofA, and some other institutions,
Mm-hmm.
they have that. Now, let me tell you this. These two products, they're different, but they help to do the same thing. So let me talk about the FHA, okay?
Okay.
In a nutshell, the FHA is the government that says, listen, we know that people run into different challenges. We know people have different economic status and so forth. There are some people who would like to buy a home and the credit score is not high. Maybe it's 550, 570. And we want to get them in a home so that they can start building wealth, building something. And so what the FHA said is that, hey, to entities that are out there, I want you to sell this loan product and give it to people who have a 550, 560, 570 credit score,
Right.
and who don't have a high down payment.
Yeah.
So on $100,000 home, you can only put down $5,000. Good. Then you can afford it. And what we do, we give you a little insurance. So that's the FHA product. Okay. So lower credit score,
Mm-hmm.
lower down payment, but they charge you a premium on the insurance. The other one that's available is the conventional. So conventional mortgages are Bank of America. You walk in there to say, okay, on that 100,000 home, bring me 10% down, $10,000. We're going to charge you less on the premium, on the insurance premium. And your credit score can be more, it has to be 650 or above. And so obviously, those are the two different products that's out there. Now, FHA, the the Federal Housing Authority, okay?
Right.
What they did is that they created another company. The company they created is called the Fannie Mae. Now, most people have heard of Fannie Mae.
Fannie Mae.
Okay, yeah. Fannie Mae, Ginnie Mae, Fannie Mae, and Ginnie Mae. So Fannie Mae and Ginnie Mae are government-sponsored private enterprises. So if you're in Liberia, it's like our LEC, right?
Yeah.
It's a government-sponsored enterprise, something like that, okay?
Mm-hmm.
So basically what they say is that everybody that's out there getting these loans, the FHA loans, we're going to buy it. So when a bank goes and issue the loan to a borrower,
Right.
after 3 months of consistent payment, Fannie Mae comes and looks at it and say, "Oh, okay, this is $100,000 loan. I want to buy it." So Fannie Mae would give the lender $100,000 plus a little profit, and they would buy the loan. So now Fannie Mae owns the loan. They own the loan, and the bank that lend the money or the entity now has $100,000 that they can go and lend it out again. So they can lend the money out again, turning over that money so many times so that they can keep the economy and everything going. So that's what Fannie Mae does.
Okay.
Fannie Mae you cannot knock on Fannie Mae door and say, I want a mortgage. No, because they give it to our lenders.
Thank you. Again, folks, in
Yes.
cyberspace, this is Focus on Liberia. This is FOL Marketplace, a business and economic forum. I'm here with my partner, William Bernard King. He's a real estate guy, and we are discussing mortgages in America, the pros and the cons. Hey, William,
Yes.
so when I was trying to get my mortgage, right? A
Uh-huh.
buddy of mine who got his before me told me,
Yeah.
Sonny, FHH is the one to go with. You will get a better
Yes.
deal, better guarantee, lower down payment, something you talk about. But when I got out of the bank, they ran my credit, they look at my income, they say, oh man, you know, FHS is not good for you at this time. You want to go
Yeah.
conventional, you have the income, you have the down payment, your credit is in good shape. With conventional, you stand a better chance, of winning some cash in the long run compared to if you go with FSH loan. How is that possible? Up to today, I can't understand it. I make that decision because I wanted a house. So tell me, how?
Yeah. Well, simple, because
Mm-hmm.
whenever you looking at this, it's all about the numbers.
Mm-hmm.
So let me tell you, Anthony, what they look at. Something that's important is FHA loans,
Mm-hmm.
the insurance, the premium they charge for that insurance.
Right.
Because they say your credit score is low, you're putting a lower down payment,
Mm-hmm.
so we want to have some kind of insurance. And so what ends up happening is that the insurance it's a little bit high. Okay, so when you look at the numbers, you say yes, you're going to get a low interest rate. You're going to get a low down payment.
Mm-hmm.
Um, this is one of the best product out there. You have the federal government who's kind of backing it.
Right.
They make sure that you're not buying a very crappy home,
Yeah.
right? They have higher, stricter inspection guidelines. And then they throw in the insurance. So when they throw in that insurance, sometimes the insurance is high. Okay, the insurance is high. So when you walk into a mortgage broker,
Mm-hmm.
runs the number and say, okay, FHA, you're going to pay low down payment, all that, but your monthly payments are going to be high. It's going to take more from your pocket every month.
Mm-hmm.
But then when you go to the conventional guy said, man, my man, on that $100,000 home, I know you only want to put $3,000 down, but I see you got $20,000 in your account.
Right.
You can put $10,000 down, and you don't have to worry about this high insurance,
Mm-hmm.
right?
Right.
And we're going to save you maybe $300 or $400 a month because of that. So that's what is presented to you, and so then you decide which way you want to go. Now, that's a good product in markets where the home prices are not as high. But when you step into the California world, where few people can afford, right now the homes are like $500,000. So they tell you to come with 10% down. That's what, 50 grand.
50 grand is a wow.
50 grand, right? You're like, man, I don't have 50.
Yeah.
But, on the other end, the guy's like, hey, FHA is only 4% down. That's 20 grand.
20 grand. I can't afford that.
Yeah. So he said, man, I can afford that any day. And you said, well, your premium will be high. Like, don't worry about that. I will figure out to pay that extra $250 a month because I got 50,000.
Right.
So that's why. Now, this is a strategy that most people don't realize.
Okay.
When you're shopping for a home, when you are shopping for a home or for a mortgage, it's like you going to the marketplace,
right,
in Liberia, and you got a whole bunch of stalls, right? Mm-hmm. And let's say you want to buy, what do you want to buy in Liberia on the marketplace?
Well, maybe you want to buy that flat screen TV.
No, not flat screen TV, man. I'm talking about in Liberia. You go to the market, you see they got all the nice green vegetables, you get excited. Oh, okay. Give me something people want to buy. Okay, it's palawa sauce season. Okay. Palawa sauce season. So you go to the first stall and then you ask the lady, hey, I want to buy a palawa sauce, right? Mm-hmm. Can you tell me if your palawa sauce price is the best compared to the other ones? Yeah. What do you think she would tell you?
Well, she would say mine is the best.
Mine is the best, yeah. Right. So when you go to Bank of America and you say, hey, I'm shopping for a mortgage, they're always going to give you only two products. They're going to give you their FHA product, or they're going to give you their own Bank of America conventional loan. Yeah. That's it. Now, if you use a mortgage broker, the mortgage broker doesn't care. he goes in the market and he finds the best product
for you.
right? It's like yeah, he finds the best. It's like you send somebody in that market, in the marketplace. You say, go find me the best price for my palawa sauce. He knows there are 15 palawa sauce sellers there. He knows them, has relationships with them, and he knows which one has has the best price.
Right.
So that's something to always consider. Don't go to the bank and think that they will have all of the products there, because a banker, he's focused on his product for his bank.
But William, this is what I heard though. I heard somebody, while I was making this decision about getting a house, this friend told me, he said, Sonny, you want to go directly to the banks, because the other institutions, the mortgage institutions that are the non-bank mortgage institutions, he said what they end up doing is maybe they will secure all these mortgages in huge quantity. The next thing you know, they're having some financial issues, and then they will sell everything to the bank and cash out on you. And what end up happening is the bank tend to raise their so if they were, maybe they sold a house to you at 3.5, and now the bank is buying it and the bank is selling at 4% or 4.5. So you see that your has gone up. So on that basis, he told me, hey, you don't want to go to those guys. They don't bank.
Thank you very much.
Go straight to the bank, because you tend to have a fixed rate and it remains like that. But now you are telling me those guys know the terrain, they will get you the best. So give me something in between there.
Well, thank you very much, Ansony. Remember, you had mentioned about different mortgage products, right?
Right.
So I give you the two basic straightforward ones, right?
Right.
Now, something else that is actually out there is called the non-traditional mortgages. Okay. So these are type of products that investors use. So investors use these type of mortgages to buy and sell real estate. So let me give you an example. Somebody to say, hey, I want to lend you $300,000 to buy this house, and you want to fix it up and flip it in about 6 months, okay?
Right.
You say, look, listen, just give me the money, and I'll only pay you interest. I'll only pay you interest. You say, okay, fine. Now your payments are lower because you're using the rest of your money to do what? You're using the rest of your money to fix up the house, to do different things and so forth. So you ended up saving money on your cash flow.
Right.
Now there's the other one where it's called adjustable rate mortgage. Adjustable rate mortgage, ARM, ARM, adjustable rate mortgage. So what happens is that the lender says, listen, for the first year, this rate is going to be pegged to the index, to the CPI, and so it's going to be flat for 5 years, for 12 months. Then after that, it's going to be tagged. So anytime the CPI goes up, we're going to increase it. So there was a lot of people that agreed to products like that, right. And those type of products would just focus on getting you into the home. And it was an investment product. So it is true that there's some products like that. However, something to be sure is that if you sign for a fixed rate mortgage, right. A fixed rate mortgage, I don't care how many times your loan is sold to whoever, unless you refi by law, that rate cannot change by law.
Okay.
So it depends on the product that you're getting. But I think there's some comments coming in too.
So before we get to the comment, let me ask the question, William. I hear people say, oh, when the market is down, when the interest rates drop, that's the good time to buy. Why is that always the case, to buy or to know when to buy?
Right. Well, people, they say it's a good time to buy. You're talking about a buyer's market and a seller's market in the mortgage world. Right. Now, let me say this. The best time to buy a property or to get a mortgage is when you can comfortably afford the payment that you can make
Okay.
on that without it really breaking your back.
Okay.
That's the time to buy. And you've made a decision that this is a place where you know you're going to stay for a while, you're going to be for a while, and so forth. And it's a safe neighborhood, good location for you, and you make that purchase. Now, interest rates is a good time to refinance if the interest rate is favorable. If the interest rate have gone down and you can refinance, sure. But it's only a good time to sign the refinance document
Right.
when you know the payment has gone down for you, and
Right.
they will tell you. So the other one is just like a myth, because if the interest rates go down but unemployment is high,
Okay.
then what happens? Now you end up forcing yourself to buy something. You can't do that. If the interest rate is very, very low, but there's a shortage of products on the market. So now most people are competing for the products, so the prices are being bid high. So now you have a low interest rate for a high mortgage. 1% mortgage on $1 million profit, that's a lot of money,
That's a lot of money. It's so
right?
true.
That's a lot of money. So it really depends on if you can afford it.
All right. Well, then, why don't you have room to read some comments? Why I made some adjustment here?
Oh yes,
All right.
oh
Read some
yes.
comment quickly.
Thank you very much.
Hmm.
So we have from hey, my buddy Sando says this. Does the refinancing start a new count of a 30 year? It depends. You can refinance up to 30 years, or you can just refinance based on where you are. And then Jeremy says, what's the difference between the big banks and the community banks with regards to interest rate? Well, big banks and community banks are pretty much, you might be referring to your credit unions. So your credit unions may be able to maybe offer you a slightly less interest rate because it's members owned versus the bank, which is shareholder owned. Um, so let's talk about, someone says, I said it depends because some people take out equity, which can reset the loan. Jeremy continues, what happened to me, William, laughing. What was it? Wait, okay. That happened. He said that happened to him. That's good. He was able to pull some money out. Ansony, we'll talk about that later.
Right.
Even if you refinance, you have to select if you want 15 or 20 years. So refinance starts with the clock. Then Sando says, if you take a HELOC, that would be second lien on your home. So we want to talk about this equity, right?
Right.
Okay, so one of the good things is that over time, uh, you're paying down your principal on your loan,
Hmm.
and your neighborhood gets better, and things are moving in your neighborhood. The government came to put a new stadium. Somebody came, they put a $1 billion museum. Somebody else came, they a big business moving right down the street from you. Your city councilman uh, is very popular. People love him. He brought in like a huge rose garden. He brought in a metro train station to the area.
Hmm.
Money is moving. Things are booming. The neighborhood is good. Crime is down. So more people want to move in that neighborhood. So now that people are moving in, there are bidding wars. So the price of your properties and stuff go up. So now you say, you know what? I got some equity in this. I wanted to do certain things. I wanted to build a school in Liberia, or I wanted to send a car for my mom, or I wanted to do something big. I want to open up a shop, or I want to pay down some debt. I'm a single man. All these women, they always on me. So what normally happens is that you tap into your equity. And the way you tap into your equity is just the way you would do a refinance.
Hmm.
It's just a refinance is like you buying the home over again yourself. You buying the home over again yourself.
Okay.
So one thing with the equity is that chances are it will increase your mortgage payment. So if you were paying maybe on $100,000 home, maybe you were paying $600. Now you might increase, it might go increase to maybe after 30 years and you refinance and you took some money out and different things like that. Maybe now you're paying 650 or you're paying 700.
So is it always like that that when you refinance and take out some equity, it tend to go up?
Well, yeah, your loan balance will increase,
Hmm.
and if your loan balance increases,
Yeah.
uh, your payment could very well go up. However,
Hmm.
however,
Hmm.
it could be where you just in a good situation where the mortgage rate, the interest rate
Hmm.
went so low, and you have so much equity in your home, and you've paid things down so much.
Right.
The combination of a low interest rate because you are in a higher interest rate,
Right.
so now you take some cash out, but because your interest rate is low, that you end up paying less. Those are not those don't happen all the time, but for certain individuals, yes, it can happen like that.
All right, again, folks in cyberspace, you are watching Focus on Liberia. The program you are listening to is FOL Marketplace. FOL meaning Focus on Liberia Marketplace is our business and economic forum where we talk issue of economics and business. William Bernard King is a real estate guy, and he is also a staff member here at Focus on Liberia, and we are talking about mortgages in America, the pros and the cons. Well, and hey, let's talk about this component of it. Uh, you hear people say all the time, you know, uh, it's best to take a 20-year fixed mortgage, 30-year. So tell me about the number of years mortgage you would take, what are the differences, what are the disadvantages if there are.
Definitely. So remember, the entity that's putting their money out there, the longer they believe, the longer time the money is out there,
Hmm.
the more they are susceptible to risk or something bad happening.
Right.
And so, with that said, if you're on a 15-year mortgage
Hmm.
and you got that mortgage in, let's say, 2010,
Hmm.
2010, your interest will be low because you only have it out there for 15 years. And then the folks that, and so they may take a point off. So instead of it being 3.75, you might just pay maybe 2.75 or 3.0.
Right.
So you have a higher payment going towards your principal and
Hmm.
your interest, but you're going to pay off your home faster. Some people are just that type of old school. They
Hmm.
want to not owe anything on their home. So there's a product available for them there. On a 30-year, you pay a lower monthly payment because it stretches out over 30 years. But you might pay a little bit higher interest rate, but you love the cash flow. You love when you go to work, you're making maybe 3,000 a month. You're only paying $1,000 towards your mortgage, and you got $2,000 to do other things with it. Versus someone else say, "Hey, I'm making 3,000. I'd rather pay $1,500 to my mortgage."
Wow, that is good. Now I see the secret. All
Yeah, yeah.
right. Yeah, like that. The
Now,
phone lines are open. You can call if you have a question. The phone lines are open. You see right there on the screen. You see the number. The number is 605-313-6004, and you want to enter that code 791-403 and then pound. You can call in. You can ask a question, and then Willen will be able to answer. Yeah, Willen.
yeah, one of the things Sando mentioned, he said, "What is the advantage of taking a HELOC from your current finance company?" So a HELOC, Anthony, is
Mhm.
just a home equity line of credit.
Okay.
So let me tell you what that means. That means that the bank says, "Hey, you have your home, 100,000 home. I see that you only owe 30,000 on it.
Right.
I want to give you a HELOC for another 30,000, home equity line of credit." So what the bank says, basically like them giving you like a credit card
Okay.
and say, "Here's a credit card with 30,000 on it. I'm not going to charge you any interest. I'm not going to do anything until you use this card." Okay, and HELOC goes up and down, but the amount in your HELOC goes up and down. Now, with the refinance, you're not asking for that line of credit. You're pretty much saying, hey, I want to take cash out. So now you have the cash in your account.
Mm-hmm.
So the HELOC on the bank side, they can adjust it. So today you feel good. You're like, man, I got 30,000 in my account.
Yeah.
No, I have 30,000 available to me. Then COVID-19 happened. Then you go and check and it's being reduced to 5,000. You say, what happened? You say, well, because they said, listen, with everything going on, we have to reduce everybody credit
Yeah.
availability of cash.
To
So
minimize the
now
risk.
minimize the risk. So that's the thing with HELOC.
Healing.
We always tend to let me know when I want to give a little history of mortgages, how they kind of came about that I think you will find interesting whenever you're ready.
Yeah, so because I wanted to ask you this question, which is, what are the things that help the mortgage market, to flow?
Right. So one of the things that help the mortgage market to flow in the US is that the US have a very robust secondary mortgage market.
Mm-hmm.
So here's what I mean. I have a loan on my house
Mm-hmm.
and it's 100,000. If you are a bank, you have that $100,000 product. Okay, you have $100,000 product, and you have 10 of them. You have 10 $100,000 products. 10. You sell the 10 to the customers, and you get paid maybe 5% interest. Okay, so every time you sell, you make $5,000, right? So that's a total of $50,000. But now the 11th, the 12th, the 13th, the 14th person come to your store.
Right.
They say, hey, I want that $100,000 product. You say, well, I don't have it, right? I don't
Mm-hmm.
have it anymore. I sold out. So when you sell out, that means you're not making money. And so to avoid that situation, you have secondary market where people say, listen, you know those $100,000 products that you sold? Yes, okay. And the person is paying interest on it? Yes. They say, I want to buy it from you. I want to buy all of them. So you had 10, it was $1,000,000. So they say, package it together and on the 10, sell it to me at a lower interest rate. So you say, okay, I'm happy with that because if I sell it to you, that means that I have more money to lend, right? I have more money to lend. So I'm more focused on my turnover. The more times I can sell my gallon of milk every time, the more profit I will make, right? So I sell you the 10. I have a new batch
Right.
of 10 to sell to the customers.
Mm-hmm.
So I sell it again, and then 10 people come and buy. So in the course of a year, if I was making 5%, that's on each. So that's 50,000, right? If I did that 20 times, 50,000, I'm already at what 100,000 plus.
Yeah, about that.
I mean, no, I'm more than that. I'm like a million
Yeah,
plus.
about a million. Yeah, so to speak, a
Yeah,
million. Yeah.
yeah. So I've turned over. I'm turning over this product. I'm turning over, and that's where the U.S. really has been big in the mortgage market because there's a secondary market. So
Okay.
the secondary market, people have confidence.
Well then,
Yeah.
so tell me about escrow. So when you try to get a mortgage, there's
Yes.
this thing they call escrow. So I
Yeah.
know I have it. There's money. Every time you make a payment, there's money in that payment that goes to escrow. What is that escrow and what's the essence of it?
Oh, thank you very much.
Mm-hmm.
And that is something that uh, it's a great tool, Anthony. It's a phenomenal tool,
Right.
and that is something that throughout your whole life, whatever it is that you're doing
Mm-hmm.
with money, build investment or different things, so forth,
Mm-hmm.
or if you're doing business, escrow is a very good way. Escrow is basically a neutral party.
Mm-hmm.
This is a neutral party in the middle that has been given very clear and specific instructions
Yeah.
on what they must do. And it's very clear. So the escrow person that says, hey, this buyer, he wants to buy a house. Okay, he has to submit his credit report in.
Mm-hmm.
Okay, he has to submit the housing inspection documents.
Mm-hmm.
Okay, he has to sign the notice of release of this. Okay,
Okay.
he has to provide his 401k. So they have all these instructions, and that's what it is. It's the middleman with all the instructions that have to be fulfilled before any money is given to the buyer and to the seller. So that way the buyer, that way the seller, you don't give him your money, and then he turns around and says, "Oh, I changed my mind." Right now, you got to go after him for your money. Right? No, no, no. So this avoids a lot of mistakes, mishaps, and so forth. It ensures and it protects both the buyer and the seller. It protects both, because you want to buy a property, then you don't want it to be registered. No, somebody else will look, and it shows that it's not registered. He could double, triple sell the same property, which is fraud. But you don't want to get into that.
So, but this is something that is protecting both the buyer and the
Hmm.
seller, isn't it?
Yes,
So then, how
yes.
come it appears as though the buyer is the one making that payment?
Oh, you mean for the escrow?
Yeah, for the escrow.
Right, right, right. So it may appear like that, but in all actuality, um, escrow payments are something that can be negotiated, depending on um, where people are in the life and with the transaction. So let me say this: traditional escrow, oftentimes you're going to have a buyer with about 75% of the cost,
Mm-hmm.
and the seller with about 25%. So, for example, if I'm buying a property, I do not want the seller to be paying for the property inspection report. Think about it. He's paying the guy that's going to tell me that this is a good property to buy. Conflict of interest.
Right.
So me as a buyer, I want to be able to be in control and pay for that home inspection report. As a buyer, there's a cost to do a loan. There's a loan fee. Well, the loan fee, the seller is not going to pay for the loan fee because he's not the one that's getting a loan. You're the one that's getting a loan. So there's that cost. There's the title fee, right? So maybe the title fee is something that can be negotiated. So all of these are the different fees and so forth to ensure that the transaction goes through smoothly. So sometimes if the seller is very pressed and he's pressured and he needs to sell, you would say, hey, listen, some of these non conflict of interest fees, I will pick up all of them. I will pick up all of them, or I'm going to give you a discount and so forth. So that's where that comes in. But there are certain fees that the bank will frown upon if they believe that the seller is the one paying for it. Certain things they're gonna raise the eyebrow, but everybody wants this stuff to go through. So as you're working this thing and so forth, some of these gray areas are things that are negotiable in terms of who's gonna pay.
All right. Thank you again, folks in cyberspace. This is Focus on Liberia, and this is FOL Marketplace, a business and economic forum. Well, so let's look at the bigger picture.
Yeah,
And I mean, I'm wondering. Look at all the homes in
yeah,
America. I know the banks are rich, right? They have so much money, but when you look at the homes, California, all the state, everywhere one goes, there are hundreds and hundreds of thousands of homes in just one state.
yeah.
Where all that money coming from to do the construction? Just the banks alone have all that money?
Well, I mean, you know, money comes from different sources,
Okay.
and like you said, something.
Hmm.
These are institutions that have been around for some 100, some 200, and some 300 years. So you can imagine on a 30-year mortgage, on 100 grand, at the end of the 30 years, you might end up paying like 70,000 over 30 years, interest and so forth. So, and now imagine a bank that own maybe 10,000 notes. That's a lot of money.
That's a lot.
So money comes from banks, money comes from private institutions, money comes from insurance companies, money comes from private families, private placements. Money also comes from the government too at times through our bonds and securities and so forth. So the source of money into housing really it's unlimited. It's unlimited. But understand this, that as a homeowner, I don't focus on the fact that I have like maybe a 700 or a $600,000 note. I don't look at it that way. I just look at it for the 1 month. Like, hey, this month I got to just worry and focus on paying that $3,200 or $4,000 note. That's it. And I do that for 10, 15 years, whatever it is. That's it. I don't have to say that oh, it's a $600,000 note. Now, as the property appreciates, and I want to talk about appreciation. So 20 years ago, maybe 30 years ago, some people bought properties in California for 150,000.
Right.
Now today, that property is worth 800,000. Right, $800,000. So when you sell it now, you have what, $700,000 worth of cash that you have at your disposal. So real estate, is definitely true. Location, 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 and that's how the market is.
Location. Hold on, Murray. William. Location, location, location. So,
Yes.
if you were advising me and said, "Oh, William, I think I want to get a second home," will you advise me to go to that suburb where not much business activities going on now, maybe a little further from the suburb, maybe on a countryside, sometimes they call it, and get that
Yeah.
house that is cheaper right now, and maybe
Mhm.
10 years down the road, that countryside turns to a bigger city, you know, a lot of businesses move there, and now that place is the place that everybody wants to be. And my house that was like maybe $300,000 now is $500,000. I'm cashing out, right?
Yeah, you can definitely do that, and you can cash out. One of the things that I learned
Mm-hmm.
in my early career,
Mm-hmm.
getting into real estate and so forth,
Mm-hmm.
is uh, there's something called speculation.
Okay.
Speculation, and one of the things you must understand is that for a real estate person who has a license, even in the wording and how to speak to you, uh, they can never say, hey, in this area, if you buy the home, it's definitely going to go up guaranteed,
Not
right? They can't
guaranteed.
say that. They can say, man, it's guaranteed to like go up.
Mm-hmm.
If they do that and somebody reports them, they're going to get in serious trouble. You always make your purchase based on the price and the things that are happening now, today. That's it. Nothing else.
That's
That's it.
it. Nothing else. Folks, in
Nothing else.
cyberspace, we are about to clock 1 hour in this broadcast. FOL Marketplace, a business and economic forum. We are talking mortgages in America, the pros and cons. So let's go back to basics to wrap up, and then we can conclude. So
Mm-hmm.
going back to basics, the pros and cons. What are the good side of owning a mortgage, and what are some of the challenges for ordinary folks like ourselves who have a family and would rather have a place of our own other than that landlord coming banking at your door and say, hey, this is going off. So what are
Right.
the things we need to look at?
Well, let's look at it. I think owning your mortgage
Mhm.
is a lot of pros, especially if you don't run into very dire financial situations where you're stressing yourself to make the payment,
Right,
where maybe 60% of your money is going towards a house note.
right,
So one of the advantages of a mortgage is that you get some tax incentives, right? You can deduct some of your interest, and you can deduct your taxes as an expense. So that's definitely one thing.
Okay.
The other thing most people don't notice is that when you own your home, you tend to take care of it more. So if you pull out your driveway, you see that trash that's right there, you're gonna get out the car, you're gonna pick up that trash, you're gonna throw it away, and so forth. The other thing is that it keeps you grounded. It keeps you grounded and makes sure that you recognize you have a responsibility. You know, payment for a mortgage and everything like that. And over time, that home could possibly be used to help you pay or fund the college tuition for your child, because you can refinance and you can then use some of that money to help pay whether they're going to college, help with the payments and so forth. And lastly, this is an inheritance. So it's a wealth. You can transfer that wealth as a legacy to your uh, loved ones, so forth. So what are some of the cons? Well, you can't just get up, uh, leave one day and say, hey, I'm not going to make this payment anymore. So it kind of ties you down to a particular area. Um, and that's definitely one of the cons that I can actually think about. That's
So
about the
for the
only.
pro also, talk to me about freedom. The leverage it gives one, especially a family, space, and especially you have children. Tell me about that as compared to you in a little apartment where you squish all you fight everybody fighting for a little space.
Right. So you in Atlanta. I used to live down south, Ansony. I used to live in Tennessee and Kentucky for a while. And let me tell you, that big space, the yard, the home, and so forth. That's something that is definitely treasured. However, in bigger cities, you find people now moving into townhomes. You find people getting smaller yards, smaller spaces, and so forth, because they can find all those amenities in different places. But rents, when you're renting a place, also understand that you're dealing with many different personalities, many different people lifestyle, life habits, and so forth. So obviously, and it's not all the way stable. People coming and going. So yeah.
All right, then you are cautioning here that the best time to buy is not
Hmm.
when the interest rate is low necessarily, but when you can afford.
Yes.
Don't say because Anthony got a bigger house with a bigger yard, he's doing his barbecue, it's on a Saturday, I
Mhm.
see he jamming music in the yard, so I'm going
Yeah.
for it even though it's far above my budget. That time is not right for you until you can afford it. So affordability is key.
Oh, Anthony, definitely affordability when you can do it.
Mhm.
That's when you need to do it. You need to work towards it. So yes, affordability is definitely critical. Now, as everyone know who's watching our viewers, we've been entering this whole series. We did about 4 weeks with credits. Now we're talking mortgage. And something that's going to be interesting, we'll be also talking about mortgages and stuff like that in the diaspora, in the Liberian market, and so forth.
Mhm.
But Sando asked a question. He said the banks do not build the homes. Housing construction companies build, and banks is in the middle from all in, funding the builders and then the buyers. So yes, that was our question, something that we said earlier. Someone said is that one of the cons about owning your own place is you have to do the repairs. The
Fine.
repairs are on you. Something to understand is that there are some warranty companies you can get for some of the major things that might happen, but yes, the repairs are definitely on you.
Yeah,
But yeah.
that's part of the con, and I didn't mean to cut you off because uh, I just repair my garage door. You don't want to believe how much I spent. I just spent 2 grand,
Yeah.
2 grand to get a new door, and
Hmm.
they did a good job. They got new frame and all that. I'm happy with the work, but I was
Yeah.
actually not preparing or not prepared to spend, $2,000 to do that. So there are other things I had planned to do with that money. Now I have to put those things on hold. Whereas
Yeah. Yeah.
if I were renting at that apartment, I just take the phone and call, and then
Yeah,
it will be
yeah.
done.
But you know that thing will like hurt you small, but
Yeah.
that is small compared
Hmm.
to the big benefits. Trust me, if you
Right.
have some kids,
Hmm.
sit tight. In 10 years, I think this is your second, third year, maybe owning third year,
Hmm.
third year, fourth year.
Right.
Wait till you get to year 10 and year 12, and you realize you're like, man, this is a good deal. You're
Yeah.
gonna, I mean, it's at first it's very painful, but at the end you'd be like, you know what, this is not a bad deal.
Yeah,
So
and I think it's a good decision. Like you said, you must count your your the cost. That you can afford it. Looking at your family size, I feel good. Being at home. My kids have their own rooms. I have mine. Everybody in their little spot. No one is in anybody's way. The family is happy, and that's a good feeling that can motivate you to make that payment, and you feel like a man and a woman too, every month.
yeah, my man, that hair on your chest standing up.
Yeah, yeah.
Trust me, this is when you go to the store, you having different conversation with people. You talk
Right.
about, yeah, man, you know I had to spend a couple of grand, man, on my
Yeah.
garage. You're not talking about Michael Jordan money no more. You're not talking
Right.
about how to buy these new J's. Nah, it's
I know.
so
I
it's
know.
a beautiful thing. Something that I want to say, Anthony, for
Right.
like wrapping up,
Hmm.
as we kind of tear down, is that
Yeah.
mortgage is a tool that is out there to use to build wealth or acquire properties and so forth. For the most sophisticated investors that are out there,
Hmm.
they use the most sophisticated of these mortgage tools because they know what they are doing. And what we have to be careful is you have to ask yourself, are you buying a home or are you buying an investment? And I think for the first time, if you're buying a property, I think that is preferable. This is just me. It's preferable that you know that, hey, this is not an investment. This is a home. So whether the market goes up or down, I'm happy with it and I'm staying in it. Regardless, this is my home.
This
This
is
is where
my
I
home.
live.
Right.
Right. And then on the other one is that if so know that for sure. And then the investment side, it's a, hey, you know what? I'm buying this. I want to flip it. I want to repair, take my money out, sell it to somebody else, and kind of move on.
So let me chip in this one. Maybe there might be some, legal concerns surrounding that, where Mr. Joe is like, you know what? I really like this house. I may not be able to afford it now in terms of the payment, but I have the down payment. I have the credit to get that approval. I may have tough time making that payment because maybe that payment is $2,000. I made three. So I'm gonna get it anyway because it's a 5,000. I mean, a 5 bedroom house. I know my buddy down the road. He would rather rent a room, and my other workmate, would rather rent a room. And these guys,
Mhm.
500, 500. I'm cool. I'm
Yeah.
going for it. Can somebody do that and it be okay?
Well, it's your house and it's your your creativity, but
Right,
your name is on that note.
right.
It might work, or it might backfire. You
Yeah,
might get a roommate who, in the morning, he or she has some interesting habits
right.
that impacts the feng shui, like they say, of your home.
Hmm.
But people have done that. You get into the Airbnb and different things. But any of those things, it's not easy. It requires work. It requires work. I tell you this, I advise, uh, in my profession, I advise one of buddies of mine. I told him, get a property, get something now, get something. And it took me 2.5, 3 years, but he barely slipped into the window because where he was at, he was paying maybe I think 1,700 for like a two-bedroom rental, 1,700, 2,000. Now that same place is for almost $3,000,
Wow.
and his mortgage is 2,200. And on top of that, very fortunate, he got a roommate because someone was looking for a place. So now he's paying half. He's paying maybe 1,200 out of his pocket.
Right.
So those are some of the things that help people build wealth. He
Right.
can put more on his phone. He can do whatever it is he want to do.
Right. It's your house. Be smart about it.
Be
Just
smart
make
about
sure
it.
you know who you're getting in there to save you the headache, and you want to get that peace of mind because, I mean, that should be your ultimate goal, right? When you get the house, when you get that car, whatever it is you're getting, you're spending your money for, you want to get that maximum satisfaction, that peace of mind, where
That's
you can
it.
sleep in peace and not be worried. William
Yeah.
Bernard King, real estate guy, a partner here, focus on Liberia. And folks, in cyberspace, we have been discussing mortgages in America, the pros and the cons. We want to say thank you for following our broadcast here. We want to believe you learned something from us. And so, if you are that person who has been thinking about making that decisions, hey, William is saying to you, we share some knowledge with you, but check with that financial institution before you make that decision. But if you are comfortable with the information we've been able to share, because here I Focus on Liberia, that's what we do. We educate, we elevate, and we promote all things Liberia. And if you feel that what we provided you is enough for you to make that decision, don't come running back to us. Hey, you guys told me it was that time. You are making your own decision. Mr. King, your final thoughts.
Yeah, there's somebody on that said I need help getting
Hmm.
a home of my own.
Yeah.
I would just respond to you privately in the chat. If it's in California, yeah, I'll be able to help you. But if it's in another state, what I can do, I can speak with you and maybe give you some little steps. We're opening our series. Very excited. This is going to be mortgage series.
Hmm.
Very important stuff. We just concluded some of the groundwork for what a mortgage is. Looking forward to more. We're going to talk about mortgage in Liberia and Ghana coming up next week. So we ask for you to join us, all our listeners and viewers. We say thank you. We have our Focus on Liberia T-shirts that's there. We want you to support us. As we support all things Liberia. So we ask that you look it up, that you pick a nice color that you really like, and so you can, support us with your Focus on Liberia T-shirt. Thank you very much.
Thank you, thank you, thank you, William. Great discussion, folks in cyberspace. Now we have come to the end of our broadcast. William was able to share that T-shirt link in the Facebook live feed there. Just go to the website, buy a t-shirt, and wear it. We are happy. That's all we want from you. The same way you see the Focus on Liberia logo behind us, we want you when you are washing us in the comfort of your home, wear that t-shirt. When you are getting on that plane, wear that t-shirt and tell the people that there are some guys over there, they are focusing on Liberia and I'm trying to support what they do. And that's all we are asking you. So folks, we can,
Anthony,
yeah.
tell us please what's going on this weekend with Focus on Liberia. I know we got some interesting topic coming up. Please share.
And more, William, Sarah, it's good you brought that up, and I appreciate that. Folks in cyberspace, we want to share with you some interesting shows that we got lined up. And today, this is the last show. We had a show this morning in the Business and Economic Forum. It's the last one. But for tomorrow, we got a package for you. At 6 p.m. Eastern Time, we will have a gentleman who is a trial lawyer. We will be looking into the entire justice system, all right, and how you, as a person of color, gain some significant understanding and how for you to be able to walk that fine line so that that's unfortunate situation that we all know about can come to your doorstep. But if at all, we will share information. Our guests will share with you how to also deal with the legal system. And then at 9 p.m. Eastern time, that's the one most of you like, politics, and it will be a political debate. The debate will be between George Lobo and Robert Gagwa. So these two gentlemen, they have fundamental disagreements about the Weah government and the Ellen government.
Yeah.
Robert Gagwa is accusing George Lobo of not saying anything wrong in the Ellen government, whereas George Lobo is saying, hey, you Robert, during Ellen time, you criticize almost everything, you saw all the wrong, but when it comes to Weah government, you are selective. You're not loud enough. So these two guys will be going back and forth. If you have seen Man Tyson in that boxing ring with Chuck Norris, then that's why we're telling you about tomorrow. You don't want to miss it at 9 p.m. Eastern Time. Dennis Jam and myself will be here. We will be moderating that debate. We will allow these guys to go ahead. So that's all we got in package for you tomorrow. If I miss anything, you still want to check on Focus on Liberia, you will see the flyer there. Continue to subscribe to our our YouTube channel, like our Facebook page also, so that you can get notification when we come on. Folks, let me tell you, life is not only about politics. My observation here is that we Liberians love the politics, 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 and politics. No, life cannot and should not always be about politics. None of you love politics more than I do, but you have to listen to other things. Come to the Business and Economic Forum and learn about economics and business. Because the decisions you make every day impact your life more than the politics that give you the headache and the frustration. So we can do the politics, but we can talk about other things. Now we're talking about the entire justice system in America. Will you now want to get that information to protect yourself and walk that fine line so that unfortunate situation can come to your doorstep? Where can you go to get that? Only here I focus on Liberia. Because why? We educate, we elevate, and we promote all things Liberia. On that note, I want to say thank you, William Kim. I want to thank you, our audience. That will do it from us. And I'm saying bye-bye. Later on, we'll watch for that sun that's coming. We are all Liberians, and Liberia is our home. Bye-bye.
Thank you.
We are Liberians.
Not yet.
Okay, buddy.
Yeah, Anthony.
Yeah.
So what I'm going to do is I'm going to then share the stuff for tomorrow. I'm going to stop putting the flyer out now. We already put it out, but I'll do it again. Right? So I think that would be good because I'm looking forward to that whole tomorrow. I'm looking forward to that whole thing. That guy been on like a little roll. Now for us, remember we got our flyer. I think you got a copy, and then we got the runner. So however way we think about, without bringing any distraction to the main topic and the main issue, how we can let people know or put it out there that we got our t-shirts for sale.